Welcome to the Deep Dive. Today we're digging into the November 2025 Arizona Commercial Real Estate Report. And, the big story isn't a collapse. It's this tricky shift from a boom to what the analysts are calling maturation.
Exactly, maturation. And that maturity is built on a surprisingly stable platform. Arizona's economy is still outpacing the nation. We're looking at a forecasted GDP expansion of 2.8% this year.
Just a little ahead of the national 2.7%.
Just ahead. And the real driver population is still delivering. 460,000 new residents since 2020. That's the foundation.
Okay, that sounds great on the macro level, but when you look closer, say, at the labor market, you start to see a few cracks. Unemployment is cooling off at 4.1%.
And job creation is really bifurcated. That's the key word.
So how does that bifurcation actually, manifest for an investor? What does that feel like?
It feels like concentrated risk.
Mm-hmm.
If you really break down the job growth, 1 in every 3 new jobs, just one sector, healthcare and social assistance. It's solid, domestic growth, but it's slow. It tells you the speculative froth is gone.
So if the domestic job growth is a bit slow and siloed, where's the really disruptive change coming from?
Well, that takes us straight to the TSMC supercycle.
The $65 billion semiconductor investment.
Right. And this isn't a cyclical trend. This is a permanent reshaping of the economy. The most stunning proof is what's happened to industrial land values up in North Phoenix.
I saw those numbers. They're just astonishing.
They've doubled. We're talking about land jumping from, say, $150 a square foot to well over $325.
Wow.
All because there's 2.5 million square feet of space being built right now just to support TSMC's suppliers. That kind of velocity is just unprecedented.
And running right alongside that is the data center gold rush. Phoenix is, the number 2 market in North America for planned data centers?
Number 2, with 1,300 megawatts under construction. But that level of power demand, it has to hit a wall eventually, doesn't it?
It has to.
It already has. That wall is power availability. It's now the major headwind. The grid is strained, and we know this because the Arizona Corporation Commission, the ACC, is now creating new policies just to manage this growth.
Okay, so let's get into the paradoxes in the asset classes, starting with industrial. The market posted, 6.4 million square feet of net absorption, a 2-year high?
A huge number. But at the same time, new deliveries dropped. 68%.
So what does that collision tell us?
It tells us that the window of savings for tenants is closing fast. Demand finally lapped the supply pipeline.
Okay, now contrast that with office. The headline vacancy is, it's not good.
Yeah.
27.2%.
It's terrible, but somehow average asking rents just hit a record high of over $30 a square foot.
High vacancy, high rent. How is that possible?
It is the absolute definition of the flight to quality. Class A space, it's actually seeing positive absorption. But the older Class B space is where all the pain is. It's seeing negative absorption. It's mass obsolescence, really.
And what about multifamily? The line in the report was that the market isn't broken, it's just overwhelmed.
A perfect way to put it. Look, demand is there. The market absorbed 16,000 units in the last year. That's double the pre-COVID average.
But the supply?
That the supply was a record 22,000 new units. And that tsunami of supply is why we're seeing rents dip about 3.3% and concessions everywhere.
Which brings us to the capital markets when you see that same split.
A total bifurcation. On one hand, you have distress, like the Avi in Tempe. It just sold at auction for $40 million.
$40 million. Down from $66.5 million in 2022?
A massive haircut. But on the other hand, you have trophy assets like the Quincy at Kierland trading for $110 million, all cash.
So high-quality assets are still attracting serious capital, regardless of the noise.
Absolutely. And while all that's fighting it out, you know what's emerged as the safe play. Retail.
Retail.
It's just exceptionally tight. We're talking sub 5% vacancy. It's a pure demographics bet. They call it roof-chasing development out in places like Buckeye and Gilbert. As long as people move here, you need more retail. It's the most stable play.
So the whole narrative has shifted. We're past the speculative frenzy of 2021 and 22. Now it's about strategic recalibration.
Exactly. Which leaves us with one final thought for you to chew on.
Okay.
We mentioned TSMC. Adjacent to that is a huge project called Halo Vista. It includes 9,000, get this, rental residences.
9,000.
9,000. So given the permanent, long-term, high-wage demand from that industry, does that basically guarantee the Phoenix multifamily market eventually absorbs all this historic supply? And if it does, is this temporary dip the best buy window you'll see for the next decade? Something to think about.